In today's video, we had a number of people in our Discord and our Telegram group telling us that they wanted to understand more about Fibonacci retracement levels. So what I want to do is I want to bring you guys onto the charts, and I want to teach you guys different ideologies and thought processes when it comes down to Fibonacci and Fibonacci levels. I'll explain how I use them, and hopefully you guys can take something away from that. So what we're going to be doing in today's video is really simple. We're just going to be going over different levels of Fibonacci retracements. What I really want to do is just make sure you guys have a good understanding of how they work and how you can avoid taking unnecessary losses in the market. So what we're going to do, I'm going to put myself over here in the corner, that, and then we're going to go ahead and get started. So when it comes down to it, what I want to do is I want to first off show you guys the FIB settings I like to use. We may have a video on this, may not, but overall, these are the FIB settings that we like to use. In regards to it, you may say, hey, there's some missing, there's some extra ones. What's the point in those? A normal Fibonacci retracement tool is going to look something like this. There will be a 23.6 level, 38.2, 50. Most of the time there'll be a 61.8. Most of the time there'll be a 78.6. Not necessarily all the time be a 88.6 or a 71. You might see a 707. 707 meaning 70.7, because that's numerically Fibonacci, like it's like, you know, Fibonacci is based off of a number sequence. So numerically, the 707 is like a key level. We rounded up to 71 just because of back testing and things like that. And then, you know, we have some extension levels, and then we have some de-extension levels. Now, what we got to do is we got to figure out what all these things mean and why they're important and why at the same time they're not important. So let's just say we have a downtrending market. The market's downtrending. It's looking like this. When it comes down to a downtrend, we take the fib from the last high down to the new low, and then from there we're looking for price to make some type of retracement before it makes a continuation down. So what we have to factor in is how you need to look at the market and understand the market with these different Fibonacci levels. Now, some of these levels are complete bullshit. So some levels are complete shit. And at the same time, so just so you guys have a good example, some levels are shitty and some levels are golden. Yes, some levels are shit, some levels are golden. Now, you as a trader need to identify what are the shitty levels to trade off of and what are the good ones. So now let's take a dive into understanding Forex terminology, or just understanding how retailers like to perceive the market. What I want you guys to take away from that is this, is that a lot of basic Forex education teaches us this, that these lower levels, aka the 38.2, 23.6, they say that if the market comes and reverses off these levels, it's a very fast retracement. And what does that do? It entices traders to say, hey, if price comes up in here into these zones, if I take a sell here, it should reverse pretty fast. That is a bullshit concept. Another thing I heard when I was coming up, mind you guys, I've been trading since 2016. So I'm giving you guys advice from all the years of my experience. Another one, if it hits the 50, it's going to be a fast retracement, but it's going to be slower than the previous one. And then if it hits a 61.8, it's going to be even slow retracement, or slower continuation is what I should say. So basic Forex education taught us that, hey, any of these lower levels are really, really good to sell at, right? These are the levels where you want to take a sell or a buy, depending on if it's an uptrend or downtrend. You know, if it's a downtrend, we're only looking to take sells, but you want to take these types of setups and you want to have continuations lower, but you're going to have a faster move down at the 38.2 or the 23 or the 50 than you would at the 61 or the 78.6 or 88.6. All of that, I want you guys to understand, is complete bullshit. That's all bullshit. Now, what I want to teach you guys about Fibonacci retracement levels is how to correlate those with basic economics. What is basic economics, guys? Basic economics is just understanding supply and demand, or discounts and premiums. Premiums and discounts, it doesn't matter. So this is an area of supply or a premium. I'm going to explain this to you guys. So right here, I have a tool drawn and it says 0.5 and then 1. So if we look at this, the 100% lines up with the 0 lines up with the 100%, and the 50 lines up with the 50. Now, this is a visual representation of how I want you guys to look at the fib and the retracement tool and everything like that. in the sense of supply and demand. Now, where supply and demand meet is called the equilibrium, or it's the halfway point. That is the 50%. Where supply and demand meet is the 50%. This is the equilibrium. At the equilibrium, what ends up happening, guys? At the equilibrium, this is the halfway point. This is the point where supply and demand meet. And this is also where you have to take into account discounts and premium. So anything below the 50 is a discounted price. Anything above the 50 is a premium price. So now you got to think about stuff. Let's say you bought a pair of Jordans or some Yeezys, or you bought a house, whatever it is. Say the equilibrium is the price that you bought at, right? Just for this example, let's say the equilibrium is the price that you bought at. Selling something for less than it's worth, or selling something at a discounted price, doesn't really make sense. If I spent $200 on these new Yeezys, I don't want to sell them for $150 because I'm going to lose. I would like to sell my $200 Yeezys for maybe $225, maybe $250, maybe $300 if someone's willing to pay that much. So when it comes down to it, in your trading career, you want to sell premiums and you want to buy discounts. So what does that mean? It means that if, hey, you just drew the Fibonacci tool from this lower high to this lower low, it means that all these Fibonacci retracement levels that are below the 50% are discounted prices. You don't want to sell a discount. You want to wait and let the market do its thing and let it come up to a premium price. When we're trading, guys, we're only looking to take sells anywhere. We use multiple confluences within our trading, but we only want to take sells anywhere between this 88.6 to 61.8 range. This is our golden zone, our golden pocket, whatever you want to call it. But this is the zone where we want to look to take opportunities, where we want to get into the market. And the reason why is because all the little retail traders that are trading 23, 38.2, even at the 50, these guys are all going to get stopped out. Maybe the trade goes in a little bit of profit for them and then it just spikes them up and it comes up here. It gives us an entry, maybe based off of something else. And then it gives us a nice move in our overall direction. So when it comes down to it, you got to understand that trading is bigger than just technical analysis and trend lines and stuff like that. Trading is about understanding supply and demand. It's about understanding premiums and discounts. It's about understanding that you as a trader, every time you click the button, you're putting your money at risk. And the safest position to be in is no position. So if you're going to expose yourself to any risk by clicking the buy or the sell button, you want to make sure that you're looking for an opportunity that is the most probable. You're looking for the most probable area to take an opportunity. So in this case, because our example was a downtrending market, I would only recommend you looking for an entry to sell above the 50%. And then on top of that, I would try to correlate fib level, maybe a harmonic, a Elliott wave, maybe a supply and demand zone, a order block, institutional candle, a fair value gap and bounce, whatever you guys like to call it. Correlate that in this zone from the 61 to 88.6, and I promise you, you're gonna have a good time. All right, guys, we appreciate y'all watching today's video. Hope you got a good understanding of Fibonacci retracements and how we like to use them, how we don't like to use them. With that being said, guys, go ahead and join the link in the bio for our Discord channel, our Discord community. It's the first link, and stay tuned and go ahead and hop on some of our free calls that we do for the community every single week. But go ahead and join the Discord, immerse yourself in the community, and start having some results with us in the chat. Peace.